Well, hello and welcome back to Jones Financial Talk. This is Nick Jones from Jones and Associates Premier Financial Solutions. Listeners, if you'd like more information about what you hear on this phenomenal show today with Mr. Tony Shore, please reach out to us in a couple of different ways. You can give us a call at 541-500-4321 or just go to our website at jonesfinancialtalk.com. Lots of great information on our website, including the radio page, where you can listen to all of our previous shows and you can subscribe to this fine program on Apple Podcasts and Spotify, even Google Podcasts and Amazon Music. But what I like most about the radio page is giving our listeners the opportunity to ask questions for us to cover on our show. And I don't know, a month or so ago, we talked a lot about how to save taxes in retirement. And we had a couple of questions that came in for some more detailed information and answers about those. So today, we're going to talk about income taxes because you really are very often having to take required distributions and different things from retirement accounts. And there are many potential steps that you can take to minimize the size of that tax bill that you're going to have if you think about it before you take those withdrawals. So Tony Shore is going to join me right now, and we're going to discuss that topic today. How are you doing, Tony?
I'm doing great. Thanks for asking, Nick. It's good to see you again, and it's good to do the show every week. I'm excited for a number of reasons, right? I got to hang out with my son last weekend. He came over because he's married. He's our oldest, and so I don't get to see him as much anymore, but he came over, and we just watched some football together because his wife was busy that day.
Nice.
He came over on Sunday. That was fun. But I'm really excited because of a big financial conference that you and I will be at coming up here. And we're going to record a show live at this big financial conference, the summit in Nashville, right?
Nashville, the best place to ever do a conference and probably the best place to ever record radio. Nashville, Tennessee. I can't wait. It's going to be fun, Tony.
It's going to be so much fun. I'm really looking forward to it. I know you'll be there with a cowboy hat and cowboy boots on and one of those belt buckles that's like, 8 inches wide. So I cannot wait to see you in your Western getup and record a radio show with you.
Sorry to be boring, but listeners, I'll probably just have a regular polo on.
Yeah. I'm giving him a hard time. I'm sure you will for the show, just have a regular polo, but it will be fun. And I know it's where there's over 500 people will be there, and some of the top financial advisors in the country will be there. And I know that you're going to be a big part of that. And that's where you share and help other advisors learn what's been working for you and your clients. And a number of experts will be there speaking as well. And it's just going to be a really good thing. I know it's a chance for you to update what you're doing each year, find out what's new, what's going on out there, right?
Totally. And this is how I get lots of topics and information and education that I get to share on the radio with many of our, fine listeners, and be able to talk to them about all these complex topics like the one today of, taxation and retirement, Tony.
Yeah, exactly. Withdrawing money from retirement accounts. Some people think, well, when I get into retirement, I'll just start taking money as I need it out of my accounts, my retirement accounts. But you don't want to do that. You can make costly mistakes. You need a plan going in. And we're going to talk about some of the pitfalls and things. And a lot of it has to do with taxes. You're right. That's the main point of it, and running out of money in retirement. So I think that, obviously saving some money on taxes and minimizing that tax burden is going to be huge. Where do you want to begin?
So let's begin with kind of the age of listeners that are before retirement or early retirees, right? So the potential first step is to avoid is early withdrawal penalties. And we've talked about this before, but if you're going to take money out of your traditional IRA before you're 59 and a half, you're going to be hit with a 10% early withdrawal penalty. However, there are many possible ways to take some penalty-free withdrawals from these types of accounts. And so one of those, Tony, if you're the age of 55 and older, is if you leave a job that's associated with your specific 401k account still, you do have in some situations, depending on how the plan is written, the ability to pull equal amounts of money after the age of 55, before you hit 59 and a half, out of that plan without that penalty. And we also have talked before on the show about what happens if you already left the plan and decided to move your 401k into a regular IRA. Tony,
Yeah.
you may know this term, but it's a very similar thing that you can do. It's called a 72T. And what this is it's a substantial amount of money that you're able to pull out before 59 and a half because it's equal withdrawals that you take every single year. There are many formulas that the IRS dictates that you have to follow in order to be able to do these types of free early withdrawals. But the idea here is if you've got to take money out, right, and it's just for normal income purposes before the age of 59 and a half, you do have options. And this is a question in some things that many people call in and ask about from time to time. You got to know what you're doing. You got to be able to sit down and look at the formulas and figure it out. But that's a huge tool that many listeners should be interested in if they're trying to accomplish that. If and the other way that they'd be able to get an early withdrawal if they don't do something like that is for something if it's approved for like a reason, like a very hefty medical bill or college costs or even purchasing a first-time home are other options. But the biggest ones that people don't think through enough probably are that age 55 rule and 72T, Tony.
Sure. Well, and I think when it comes to withdrawals from retirement accounts, sounds like from what you're saying, there's two hugely important things. Have a withdrawal strategy going
Yep.
in, right? Have a
Yep.
withdrawal strategy and work with a financial professional like yourself before making any of those moves to make sure that you're doing what's in your best interest and it's not going to cause you a tax burden or a costly financial mistake, right? Taking it from the wrong place at the wrong time.
That's right. That's right.
Yeah.
Another thing that comes into play here with people that are, I'm saying in the earlier stages of retirement or pre-retirement, is rolling over money from a 401k, right? And so if you roll money out, you better make sure that you do it correctly. If you don't, you're going to have some tax withholdings. You may even have to withhold up to 20% if you don't do it correctly.
Right.
You have a certain amount of time when you can move the money over. That's typically around a 60-day period. So you've got to make sure that you're working with somebody that helps you figure that out so that you avoid not only early withdrawal penalties, but also taxation if that's not what you're trying to accomplish. And most of the time, Tony, if you do a direct transfer from a trustee to trustee, that is not an issue. But sometimes plans are written in a way that they won't allow you to do that. So you have to work with somebody that's willing to help you do that.
Yeah, exactly. And that's where you come in, I know, to help people with these strategies. So making sure it's squared away, I think that's really important. What about RMDs? So when you're older, I know that they make you take distributions from an IRA, and that's called a required minimum distribution. Is that right?
That's exactly correct. So yes, you are required to withdraw money from traditional IRAs and IRAs once you reach the age of 73 today. And the penalty for missing an RMD is 25% of the total of what you should have withdrawn. And so that penalty is on top of the income tax that's required on the withdrawal, Tony. So if you're supposed to take 10 grand out and you make a mistake, right, you're looking at $2,500 penalty on top of the taxes that you were supposed to take. If you realize your mistake and quickly correct it, maybe the penalty goes down a little bit to as little as 10%, but it's still a penalty. So again, you have to work with somebody that is helping you keep track of this. So this is a huge task for any firm. We keep track of this for all of our clients and try to figure out for them right away on January 1st what their required minimum distribution is going to be for that year. And this is a topic that we discuss with them many times, not just
Sure.
once at the end of the year, many, many times.
Yeah. Yeah. And I think that's really important. Obviously, there are the charitable distributions are important. You can utilize those. And I think an older RMD age, even if it's a decade in the future, that's something that's good. But you'll want to discuss that because things are constantly changing with these rules, aren't they?
They are. The ages have changed a lot just in the
Yeah.
last 4 or 5 years, right? It used to
Yeah.
be 70 and a half when you had
Yeah.
to take a distribution, and then 72, and now it's 73. Well, it's going to 74 and 75 as well, which is a good thing. But you have to understand, how your age today helps you figure out what that equation is.
Mhm.
Okay. And another thing is you don't want to accidentally take two distributions in the same year, right?
Right.
So your
Right.
first RMD is required no later than April 1st of the year that you turn 73. Okay. After that, your next and every other following distribution is required by year end, December 31st. So if you delay your first distribution until April, you may end up making, the mistake of taking two distributions in the same year. And what's going to happen in that situation? You took more money out, you're probably going to pay more taxes, or
Yeah.
you might even get moved into a higher tax bracket. So those little nuances can save you lots of money from a taxation standpoint
Yeah.
and penalty standpoint that we want you to avoid, listeners.
Yeah, you want to avoid those penalties. They can really add up because if you get like that 10% penalty, that's on top of the taxes, as you
That,
say. So that's really, really important. And I think that work with a financial professional. And I think people will want to discuss taking withdrawals, especially if they take withdrawals before they're 73. You want to talk about that to see what account you're withdrawing from and the account type that you take it from, whether it's a Roth or a traditional, that makes a lot of difference.
that's a great point, Tony, because while you're not required to take money out of a traditional retirement account until you're the age of 73 today, if you take smaller distributions while you're still in your 60s, that may help you spread out your tax burden over many years. And it's also going to keep you in maybe a lower tax bracket, which ultimately means what? You're going to potentially shrink that lifetime tax burden, which most people are very concerned about. And making 401k and IRA withdrawals when you have smaller, income in a specific year, or perhaps you've retired and haven't started taking Social Security yet. All of these things are ways that you're going to reduce your tax burden. And so you just got to sit down with somebody and make sure you time all these things correctly. I just sat down last night with a potential client that's going to retire in 6 months. And the reason why we do that is there's lots of steps that have to take place for both him and his spouse between now and then before they start drawing Social Security. You've got to think about the fact that if you're going to retire in the middle of the year, you've already made income for that year, right? And so that's going to
Right.
automatically put you in a different tax situation than if you have just been retired the entire year, for instance.
Sure. So it makes a difference when you retire, what your time horizon is, what the timeline is, when you file for Social Security and how you file is so important. There's so many factors. I mean, the more we talk on these shows, the more it just illustrates the point where you need a professional like yourself who goes through these processes every day. You've been doing it for years, helping your clients have successful retirements and success with their finances. That's what's important here. Now, we should probably take a moment so our listeners can have a chance to give you a call. How can they contact you if they want to set up that no charge, no obligation consultation?
Sure thing. So they can just give us a call at 541 500 4321, or they can go to jonesfinancialtalk.com and request any information or to meet with us in person. We'd love to hear from you, listeners.
All right. That sounds fantastic. And this has been a great show so far. We're talking about how you can save money on your retirement withdrawals. There are tax implications. Most retirement accounts are tax deferred, which means you're going to pay the full taxes on everything when you take it out, the interest earned, the principal. And so, how are you going to do that? And how can you come up with a strategy for your withdrawals in retirement? What do you have for us next?
So let's dive a little deeper into, charitable donations, because everybody asks me a little bit more about this. And,
Yeah.
today, Don't ask me why it's this age still, listeners, but today, people who are at least 70 and a half may avoid paying income tax on IRA withdrawals as much as $100,000 for an individual and $200,000 for couples per year if they contribute that to a charity. And, a qualifying charitable donation must be made directly from your IRA to that qualified charity. That's a huge, huge thing you have to keep in mind.
Yeah.
You aren't required to itemize your taxes. This was a question. So you're not required to itemize your taxes to make an IRA charitable distribution, and you're permitted to donate to multiple charities. Okay, so an IRA charitable donation meets that minimum distribution requirement as well if you are at the age of 73 and above. So all of these things are very important to understand if you're going to be making charitable donations. Many of my clients make donations. They tie to their church or they do something specific for specific charities. Well, if they knew that they could give money out of their IRA to accomplish the same thing out of their regular cash account, and they don't have to pay the taxes as a result of it, that's a huge difference. So something worth discussing and figuring out.
Yeah. So what you're saying is, for the listeners out there, to explain what you're trying to say here is that if you have a traditional IRA with money in it and you're over 70 and a half, you can take that money, which went in tax-free.
Yep.
You can take it out tax-free if you have it transferred directly to a charity from your IRA. And so then you've never paid tax on that money. Plus, it's something that you would have done anyway. Like a lot of people out there tithe, Nick. And
you got it.
Some people tithe $10,000 a year. Well, if they're over 70 and a half and they're still writing checks to their church for their tithe, they're making a costly mistake because they could be saving taxes on all that money and using a qualified charitable distribution or QCD from their traditional IRA, right?
Yeah, I mean, in that situation, and just the lowest tax bracket, Tony, if you're making that big of a contribution to a charity, I mean, you could save a couple $1,000 just by doing it directly.
Yeah.
And
it still benefits the church or the charity as greatly, and it benefits you from a tax burden standpoint. It's a win-win, really.
And you don't even have to itemize your taxes to do it. It's just something that a direct custodian will do on your behalf and will be shown to the IRS that it was done correctly. And so great thing there for sure.
Yeah, that is huge. Now, and a lot of people out there, you've talked about this, how clients have organizations they support. So I think that's a good option to discuss with you if somebody's interested in doing that before they just, try to do it on their own. They should probably talk to a financial professional to make sure that the custodian of their account does it correctly. And I know that this is something you can help people do as well.
Well, and every year, I mean, it's been amazing to me in the last 4 years since 2020 when the CARES Act came out, how quickly tax law has changed and how all these little specifics have changed, and so even if I would have done a radio show 3 or 4 years ago, the information is outdated because of how quickly taxation laws in our country change. And guess what's going to happen at the end of this year? We're going to have a presidential election, and also the previous administration, Trump's tax, incentives go out in 2025. So we are actively always looking at and trying to figure this out to make sure that you, as our client, is has the upper hand from a tax standpoint, Tony.
Yeah, that's huge.
Another thing that I'll talk about is, funneling some of your retirement savings into an after-tax Roth account could potentially really help from a tax-free investment growth and tax-free withdrawal amount during your later years. While you're not going to benefit from that tax deduction in the year that you make that contribution, you're not going to be required to put and pay income taxes on any of the investment growth that's inside that account going forward. And you don't have to take any required minimum distributions from those types of accounts either at any specific age. And, if you think that there's going to be a chance that you're going to end up in a higher tax bracket during retirement, or if you feel like I have mentioned on the show many times that taxes are probably just going one direction in our country, up from here, then a Roth may also help you maintain the current lower tax rate by doing it now.
Yeah. Yeah. And then I know we've talked a lot about Roths, and there are so many positives when it comes to Roth. You need some income in retirement in that tax-free bucket, according to you, and things you've said on the show. That's important. But there are certain situations where a Roth might not be the best fit for someone, right?
Definitely. So, the biggest potential danger that I see is putting money into a Roth account or converting money into a Roth account. Um, you know, when you're expecting that you're going to be in a higher tax bracket, right? But what if you're not in a higher tax bracket? What if when you retire, you make less income, or because of the way that taxes shift so quickly in our country, you're actually in a lower bracket? If you are, then that might be a situation where you just now added insult to injury by just putting money into the Roth and paying it prematurely, right? And so there are, other potential disadvantages with Roths as well that you definitely should discuss with your financial advisor. I'd say the majority of the time, Roth IRAs are phenomenal tools that you can use, but not a great fit for everybody. And I do tell people that on occasion. No, not a reason for you to convert. So, for instance, I just had some clients I talked to you about last night, and one of the questions they had was, maybe we should start converting some money into a Roth now. And I said, well, no, because based on the income projection that I have for you, you're going to put yourself in a higher tax bracket as a result of doing that when you retire. And you don't want to be in that higher tax bracket. If you stay in the lower tax bracket and not convert to the Roth, all of your income, is taxed at a lower rate. So all of these things change. You just got to have the discussion. You're on mute.
Yeah, that makes perfect sense. And Nick, when they are putting money into a Roth before they retire, or when you're putting money into a Roth, some people may make too much to contribute to a Roth. Now, you can still do Roth conversions, which is helpful, and that's what they call the backdoor Roth, right? Where
Yep.
You put money into a traditional IRA and then can later convert it into a Roth, and that's
Yep.
another way, up to $8,000 a year. I think the number is right now. So
that's definitely correct.
yeah. Okay. So I'm still curious about the charitable donation. Go into some more detail about that. How does that work?
Okay.
For our listeners, we've had some questions about that.
Yep. So specifically, you can only do this after you're 70 and a half, right? And in order to meet that requirement and be allowed to transfer that huge amount up to $100,000, it's got to be from your IRA to a qualified charity, directly. And that's the biggest thing. And so usually the custodian that holds your IRA is going to have a process for you to handle that. And like when our clients call us and say, okay, look, I've got to take $20,000 out this year as my RMD. For instance, I have these 4 charities I want to send money to. They give us all the information for the charities, and the custodian where our money is held is sent directly to those charities. They don't touch it. Okay. And if they do that by the end of the year, December 31st, then it's excluded from their taxable income.
Yeah.
Simple as that.
Yeah. Well, that is simple. So, and so you've explained how to make qualified charitable donations. You've talked about that somewhat. And I think a lot of people out there, like I know people who regularly tithe and that just cut a check every
Yep.
week. And you've probably come across that too.
Definitely. One thing I wanted to mention also as a specific here, Tony, charitable contributions may only come from IRAs. They cannot come from 401ks or similar amounts. So that means that if you're going to do this, you might need to move the money from your current 401k to an IRA. If you
Good
want to
point.
take some of those tax-free donations. But there's also disadvantages from moving your money out of your 401k to the IRA. So lots of different things you got to talk about when we sit down with clients and try to figure out the best course of action for them. It's for their specific reason, which is totally different than the last person that came in the door.
Yeah.
So that's the whole point.
Yeah. Yeah. So in our remaining time, we got a few minutes left here. We've talked about a lot, and I mean, it seems like these topics come up a lot, but we do still get a lot of questions, and there's a lot of people out there that don't quite understand how these different types of retirement accounts work. 401k, you have 401ks, 403bs, IRAs, traditional IRAs, I should say. Then you have the Roth IRA, which you mentioned, which is a tax-free account. You have to pay taxes on the money before it goes in, but then it grows tax-free, and the principal and interest after a certain time period can come out tax-free in retirement. And that's really beneficial to a lot of people because, we all assume taxes will go up. And they're even scheduled to go up at a certain point at this time. But with the deficit spending, wouldn't you say with our deficit spending, they either have to do one of two things. They have to raise taxes or they have to cut spending. And I know which one I think the government will do.
Totally.
How about you?
Yeah, I agree with your inclination for sure, Mr. Short.
Yeah.
The other thing, though, that people can think about, and that is totally a valid point for this year remaining, because we know where tax rates are, is thinking about placing some tax preferred investments outside of their retirement accounts. That could be a great option for them. And so let me explain a little bit about that, Tony.
Sure.
If you're going to hold investments for over a 12-month period, for instance, then the taxation laws change. It becomes a long-term capital gain, and you receive some special tax treatment rather than having it be just ordinary income if you make it in less than 12 months. For instance, when you get interest from a bank, which I know many people haven't for many years, but now banks are paying some interest, you do have to pay taxes right away at your regular income rate. If you use specific types of investments for taxation purposes, and you plan those according to what your client's objective is and what their risk tolerance is, that can be hugely beneficial. And we use many different types of tax advantaged investments for that specific reason. Let me give you another example. Last week, I sat down with some clients that recently sold a building, had a large sum of money that they wanted to invest. But what do you think the first question is that they asked, or the first concern is?
How much do we have to pay in taxes on that?
We just sold this piece of property and now we owe 25 or 30% in taxes as a result of that. Like, what are we going to do now? And I said, well, it depends on what you want to do. But if you use the wrong type of investments, all of the interest that you make on your new money going forward is fully taxable. If you use tax preferred investments, maybe some of that is deferred. Maybe some of it is not taxed at that higher rate. And today, we know for certain for the rest of this year that tax rates for longer term capital gains are lower. Will that change? Probably next year, because we don't know, like you said, what tax rates are going to do. But the point is, I hope that when you are having that conversation with your advisor, that they're adamantly asking you about your tax situation, how you feel about different tax preference treatment with what you're going to invest in, because that is a huge thing that you have to remember.
Yeah. And I know that you have a team of professionals there that you work with in your office, and you work alongside tax professionals with your clients. But somebody has to be the quarterback and look at the overall picture. And that's where you come in and look at everything from Social Security to the minimizing that tax burden, and where the investments are at, and how taxes affect different investments. So very important when it comes to income planning and retirement planning. Huge. We're out of time for today's show, though. One more time, let our listeners know how they can get a hold of you.
Sure thing. So you can just give us a call at 541-500-4321, or go to jonesfinancialtalk.com and request that information from us. Please do so, listeners.
All right. And that does it for today's episode of Jones Financial Talk with our host, Nick Jones.